with something way bigger than Bitcoin, something that affects every asset on earth, and it's liquidity. Because when liquidity disappears, it doesn't matter how strong the fundamentals are. It doesn't matter how much demand there is. Everything gets hit. And that's exactly what's been happening over the last 6 to 8 weeks. Now, the first thing most people missed is that the US government went through the longest shutdown in American history, 43 days. And when the government shuts down, spending freezes. The Treasury General Account, the TGA, it's the government's checking account, swells up, and all that money that swells into it comes out of the system. And of course, every time the TGA jumps, you see risk assets start to pull back because the liquidity is getting drained from the exact places the markets rely on for the day-to-day funding.
When Bitcoin's chart turns red, most people search for a villain. Mark Moss searches for the truth buried in the liquidity data. Mark Moss, an entrepreneur, investor, and economic commentator, argues that Bitcoin's recent 32% pullback is being widely misinterpreted across mainstream financial discussions. Rather than reflecting any deterioration in Bitcoin's fundamentals, he points to a much larger force shaping the move, a global liquidity squeeze. Drawing on Warren Buffett's reminder that markets behave like emotional voting machines in the short term, Moss highlights how fear, not fundamentals, has amplified the reaction. Bitcoin has experienced similar declines throughout past cycles, yet the heightened panic surrounding this drop reflects sentiment, not structural weakness. A central component of Moss's analysis is the rapid tightening of liquidity across financial markets. The 43-day U.S. government shutdown, the longest in modern history, froze federal spending and caused the Treasury General Account to surge, siphoning liquidity directly out of the financial system. At the same time, the Federal Reserve's quantitative tightening continued, pulling reserves from banks, pushing them toward levels last seen before the 2019 repo crisis. With the reverse repo facility nearly drained and overnight borrowing costs climbing, liquidity pressure accelerated sharply. Dealers reduced leverage, risk appetite fell, and every liquidity-sensitive asset came under strain. Bitcoin, known for reacting fastest to macro tightening, adjusted accordingly. Moss's assessment ultimately shows that the downturn reflects temporary liquidity stress rather than any weakening in Bitcoin's long-term outlook, reaffirming the asset's resilience in broader market cycles. If this breakdown helped clarify what's really driving Bitcoin's volatility, be sure to drop a comment, share it with others following the markets, and subscribe for more data-driven insights.
Bitcoin's price is crashing. Now, at the time of this recording, probably going to change by the time you watch this, but we're at about 85,000. It's about 32% off of its previous all-time high that was set back in October 13th. And everybody's looking around. They're all trying to figure out, like, what the heck just happened? And of course, more importantly, what comes next? But the problem is that most of the explanations out there that you're seeing, maybe online, on Twitter, whatever, they're guesses, right? They're headlines. It's whatever narrative people grab, whatever they can find the quickest. And none of it actually matches the data. But before we go anywhere, before we talk about the seller, before we talk about the microstructure, before we talk about the timing of the moves, we have to set the right frame, right? This is when I always go back and I listen to good old Uncle Warren Buffett, the Oracle of Omaha, because he has all these little lines, these little sayings, ones that I think about a lot, especially when markets start acting very emotional like right now. And he has a really famous one. He said, quote, "If you're not willing to own something for 10 years, don't even think about owning it for 10 minutes, end quote. And of course, the other one everybody quotes all the time is price is what you pay, value is what you get. But the one I think fits this moment right now the best, the most perfect one for this moment is in the short run, markets are a voting machine. In the long run, they're a weighing machine. Now, if you've been around these cycles long enough, you know exactly what he's talking about, right? Because right now, the voting machine, it's in full panic mode. Bitcoin, again, it's down 35%. It's a big move. But really, when you look at the bigger picture, it's not unusual for Bitcoin. In fact, it's the third drop of this size in just this current cycle. And we've seen dozens of these in previous cycles. But what is unusual is the sentiment this time. That like this drop right now, this must mean something is fundamentally wrong. So let's walk through this very carefully and take a look. Like, let's lay out the framework. Let's lay out the evidence so we can understand what's going on. Because once you line up all the facts, it becomes really clear that the long-term picture It hasn't changed at all. And really, the fundamentals have actually never looked better. Now, before we get to the fundamentals, let's stay on Buffett just for one more second, because understanding how he thinks, how he became one of the wealthiest men in the world, is something that we should all learn from. And I know he's not a big Bitcoin fan, but we can still learn from him. Now, Buffett never buys something and then sits there staring at the price every day. He said over and over, he doesn't care what the price does today or tomorrow because he's not buying the ticker, right? He's not buying the price. He's buying the business. And if the business is getting stronger and the price is falling, then he doesn't panic. He just buys more. Okay, so before we get emotional about, the red candles, before we get emotional about the headlines, what we want to do is we want to do exactly what Warren Buffett would do. We want to zoom out, just ignore the noise for a second, and let's get to the facts. Because the facts, they paint a completely different picture than the emotions do. Okay, so now that we've got the right frame of mind, let's go straight into the first big question. Why is the price falling? Like, what happened? Now, before we get into the market makers and the forced selling and all that, we have to start with something way bigger than Bitcoin, something that affects every asset on earth, and it's liquidity. Because when liquidity disappears, it doesn't matter how strong the fundamentals are. It doesn't matter how much demand there is. Everything gets hit. And that's exactly what's been happening over the last 6 to 8 weeks. Now, the first thing most people missed is that the US government went through the longest shutdown in American history, 43 days. And when the government shuts down, spending freezes. The Treasury General Account, the TGA, it's the government's checking account, swells up, and all that money that swells into it comes out of the system. And of course, every time the TGA jumps, you see risk assets start to pull back because the liquidity is getting drained from the exact places the markets rely on for the day-to-day funding. Now, on top of that, the Federal Reserve, they're still running QT, or quantitative tightening. So while the shutdown froze fiscal spending, QT was pulling reserves out of the banking system. And if you watch the bank reserve levels, you can see the floor getting hit pretty quickly. Now, this isn't a guess, right? It's all in the data. Reserves fell back to the same danger zone we reached in 2019, right before the repo market blew out. And while that's happening, the reverse repo facility, it's basically empty, which is another major signal that the system is getting tight. Now, the reverse repo dropping to near zero means money market funds have nowhere to park excess cash because no excess cash. Overnight borrowing costs between banks have been creeping higher and higher and higher for weeks. Dealers are pulling back risk. Leverage is coming down across the board. So when all this happens, you get a temporary liquidity vacuum. All right, now this hits everything. It's just that Bitcoin reacts to this the fastest.
Bitcoin just faced one of its most dramatic market shakeups in history, revealing deep structural shifts beneath the surface. On October 10, 2025, the Bitcoin market faced an unprecedented structural shock, marking one of the largest liquidation events in crypto history. Geopolitical tension, sparked by President Trump's tweet announcing a 100% tariff on China, triggered nearly $19 billion in leveraged Bitcoin positions to be forcefully unwound within 24 hours. Total open interest fell by 27.5%, dropping almost $60 billion to $158 billion, with the sharpest drawdown occurring in just 25 minutes. This was not a typical market correction. It exposed critical vulnerabilities in Bitcoin's market microstructure. Forced liquidations impacted both traders and market makers, blindsiding liquidity providers as hedges were forcibly closed through ADL systems. Liquidity evaporated, risk exposure declined, and quoted sizes shrank, leaving destabilizing gaps. Exchanges like Binance experienced record forced liquidation clusters, while a $200 million delta-neutral fund, Stream Finance, collapsed after losing $93 million, intensifying the chain reaction. Evidence of a systematic unwinding appeared in Bitcoin being sold consistently at 9:30 a.m. Eastern Time. Technical indicators, including the lowest daily MACD and an RSI of 21, signaled extreme pressure without full capitulation. Despite this turbulence, growing institutional adoption, mining investment, and sovereign interest reinforce Bitcoin's long-term fundamentals, marking the event as a temporary structural dislocation rather than a fundamental weakness. Let's get back to the interview.
right? We have to get into the part that almost nobody understands. This is where things get a little bit weird because the price action that we've been seeing the last few weeks doesn't look like fear, right? It doesn't actually look like normal selling pressure. It looks like something broke. And the date everything changed was October 10th, 10/10. Remember that day? That's the day President Trump sent out the tweet. He said that he was going to put 100% tariffs on China, and then it triggered one of the largest liquidation events in crypto's history. Almost $20 billion in leveraged positions were wiped out in less than 24 hours. Now, that's not normal, right? Bitcoin didn't drop 50%. The ETFs didn't give back give all the redemptions back. There wasn't some major macro shock, but the size of the forced liquidations was bigger than what we saw in some of the 2022 candles. Now, here's the key. When liquidations get that big, it's not just traders losing money. Market makers took this too, right? These are the firms that provide the liquidity, that lift the books, that stabilize the volatility. And when they get blindsided, when their hedges get liquidated, and when exchanges use ADL to force close their positions at horrible prices, they don't just get hurt, they pull back, right? They reduce risk. They have to shrink their inventory. They quote smaller sizes. That starts to leave holes in the market structure. And that's exactly what we saw on 10/10. Now, we can take a look at Binance, for example. They had one of its largest forced liquidation clusters ever. Wintermute's CEO publicly said Binance's ADL system malfunctioned and hit them with fills that, quote, make no sense. Now then, right after that, we saw the collapse of Stream Finance. It was a $200 million delta neutral fund. They lost around $93 million and went bankrupt. Now that's a fund that wasn't supposed to lose money, but their hedges, they got caught in the same ADL chain reaction. Now, when you put all that together, a major liquidation event, ADL kicking in, a large fund blowing up, you end up with exactly what we've been seeing ever since. And it gets even more strange than that. For almost 2 weeks straight now, someone's been selling Bitcoin every single morning at 9:30 a.m. Eastern time, the exact moment the U.S. stock market opens. The same pattern, the same timing, the same pressure. This isn't retail panic, right? Retail doesn't wake up and then dump Bitcoin at the opening bell on Wall Street with that kind of precision, right? This looks like has to be a mandated seller, right? This is a fund that's unwinding. It's a market maker that's de-risking their portfolio. Somebody's closing a position because they have to, not because they want to. And the technicals back all this up, right? We just hit the lowest daily MACD reading in Bitcoin's history, lower than the COVID crash, lower than the FTX collapse, and yet the price is only down 33%, right? That'd be impossible in a healthy market. RSI hit 21 on the daily. That only happens during true capitulation events, but there's no capitulation this time. The price action is all pressure. It's no panic, right? That's the tell that we're looking at. This is one or maybe more forced actors unwinding through a broken microstructure. The 10/10 event, it damaged liquidity. Now, the seller that we're seeing is basically dragging their inventory through the weekend market. Fidelity, Citi, US Bancorp, Standard Chartered, they're all running regulated Bitcoin custody operations now. And the important point is that when institutions buy Bitcoin and custody it with firms like that, those coins, they disappear from the liquid float for years maybe, right? They're not trading on Binance. They're not part of this noise. They're effectively locked away in deep, dark, cold storage. Bitcoin mining investment, it hasn't slowed down at all. Hash rate hit a new all-time high this year. It means the network is more secure than it's ever been. And when you see miners investing hundreds of millions of dollars into hardware, energy contracts, it tells you one thing. They're not worried about short-term price moves. And then you've got sovereign adoption starting to accelerate. The U.S. now holds over 200,000 Bitcoin between seized assets and strategic reserve discussions. Now, multiple states are exploring Bitcoin treasury allocations. Other countries are openly studying strategic Bitcoin reserves. Now, this part's still pretty early, but the direction, it's undeniable. So when you stack all this up, institutions are accumulating, Bitcoin entering the credit system, mortgage underwriting guidelines changing, regulated custody exploding, minus security at all-time high, sovereign interest building. And then you compare it to the price dropping 35%, it becomes really obvious what's happening here, all right? This is exactly the kind of setup that long-term investors wait for when the weighing machine hasn't caught up to the voting machine yet, or what I like to call the mismatch multiplier. How far off of reality is to perception, the mismatch. The greater the multiplier, the better the opportunity.
The recent turmoil in the Bitcoin market highlights the delicate interplay between liquidity, leverage, and market microstructure. The unprecedented forced liquidations and subsequent gaps in liquidity illustrate how structural vulnerabilities can amplify price swings, even without a fundamental shift in demand or adoption. Repeated, precise sell-offs at market open suggest that coordinated unwinding by large holders and market makers continues to exert pressure, separating price action from true market sentiment. Technical indicators, including historically low daily MACD readings and extreme RSI levels, confirm significant stress without a full capitulation, pointing to mechanical pressure rather than retail panic. Meanwhile, robust institutional accumulation, growing sovereign interest, and record-high mining investment indicate that long-term fundamentals remain resilient. The current dislocation demonstrates that short-term volatility is increasingly shaped by structural dynamics and liquidity constraints, emphasizing that Bitcoin's broader trajectory is driven by systemic adoption and security improvements rather than temporary market shocks. How do you see Bitcoin navigating these structural market shifts? Could this volatility create a long-term buying opportunity? Stay informed on Bitcoin's market moves. Comment your thoughts, share this analysis, and subscribe for the latest crypto insights.